Welcome to the Deep Dive. This is where we tackle a huge pile of research, data, articles, everything, and boil it all down into what you really need to know. Saves you hours of work. Today we're doing a pretty high-stakes deep dive. We're looking at one of the world's most complex defense tech companies, Elbit Systems Ltd. That's ticker ESLT. Our mission for you, the learner, is to really unpack the story behind this international player. They're headquartered in Haifa, Israel. And look, this company is just perfectly positioned for this massive global defense spending boom, what people are calling a super cycle. But just looking at the growth, the huge numbers, the record financials, well, that's just not enough. We have to spend just as much time understanding why Elbit's unique technological edge is also the main driver for some really significant and kind of unpredictable business risks. It's a company really defined by this core defining paradox.
Yeah, absolutely. And just to set the scene a bit more, Elbit Systems, it's public, listed on NASDAQ, also the Tel Aviv Stock Exchange, the TASE. So this isn't some small niche player. It's a global industrial leader. We're talking, as of October 2025, a market cap around $22.6 billion. They've got about 20,000 employees globally, and they're a key supplier, within the defense industrial base for the US, the UK, a lot of Europe too.
That context is absolutely vital. Okay, let's tackle that core paradox right away because it feels like understanding this tension is really the key to figuring out Elbit's whole strategic position. And frankly, it's pretty steep valuation.
It really is. It's like the gravitational center of their whole business model, you could say. Elbit's #1 competitive advantage, the absolute pillar of their tech development, their marketing. It all comes down to their deep institutional relationship with the Israel Defense Forces, the IDF.
Right, and you're saying this goes beyond just a normal supplier-customer thing.
Oh, far beyond. Think of it as this crucial, super fast, intense feedback loop. When their systems get deployed, tested, refined in really high-intensity situations, specifically the kind of complex, asymmetric conflicts the IDF deals with, Elbit's engineers get instant high-quality feedback. Real-world data. This lets them develop and then certify what they sell to the world as battle-proven solutions. And that specific label, battle-proven, it commands a premium everywhere because it signals high reliability, operational relevance. It means it works under extreme pressure.
Battle-proven, that's their global currency then. But let me ask you this.
Yeah.
How do they actually sell that idea? I mean, to a client like, say, the German Bundeswehr or the UK Ministry of Defense, aren't those organizations highly bureaucratic? Don't they need rigid, standardized NATO testing? Would they even accept active conflict as enough validation?
That's a really critical question. So what they do is translate battle-proven into things those clients understand. Tangible metrics, faster deployment times, lower failure rates for components in harsh conditions, the ability to integrate diverse systems seamlessly, under battlefield stress. But here's the huge flip side. And this is where, it gets really interesting. That very same badge of honor, that deep IDF connection, the battle-proven label, that's the main catalyst for some serious geopolitical vulnerability.
Ah, okay. So the thing that makes them strong is also the exact thing that makes them risky.
Precisely. And we're not talking theoretical risk. We mean direct, financially significant consequences. Things like politically motivated contract cancellations, delays happening on key international bids, and also these very public, very coordinated divestment campaigns. Major institutional investors think Norway's huge sovereign wealth fund, big banks like HSBC, say they've all moved to divest their holdings in Elbit. Why? Because of ethical and ESG pressure, environmental, social governance stuff directly linked to that battle-proven status.
So their main competitive tool constantly generates this kind of systemic political cost or headache for them.
That's exactly it. It's a constant tension.
Okay, that sets the stage perfectly. This deep dive, it definitely needs more than just the standard P&L analysis. Let's get into the fundamentals now. How do they actually make money? What's the structure look like before we circle back to those complex risks?
Right. To get a handle on Elbit's revenue, you really have to look at the pillars of the business. It's spread across 5 main segments, but they're all highly interconnected. It forms the basis of their whole strategy. And we can see the scale if we look at the breakdown for fiscal year 2024 revenues.
Okay, kicking us off is the biggest one, aerospace. That brought in 27% of their revenue in 2024, just over $2 billion, $2.036 billion to be exact. When we say aerospace for Elbit, what does that cover? Military aircraft, helicopter systems.
Yeah, advanced electro-optics, those helmet-mount displays pilots use, and crucially, their unmanned aircraft systems, UAS drones.
Right, the drones. That seems central to their identity now.
Oh, absolutely. The UAS line is huge for them. Their flagship system is the Hermes 900. It's what they call a MALE drone, medium altitude, long endurance. Basically used for strategic recon, long-range surveillance. What makes it so popular is its flexibility. It can fly for over 30 hours straight, carry a pretty hefty payload of different sensors, and it's built with an open architecture. That means customers can plug in their own intelligence systems. It's exactly the kind of high-demand tech everyone wants in today's security climate.
Okay, next up, moving to the ground. The land segment. That's 23% of revenue, about $1.679 billion. What falls under land?
That covers a lot. Things like modernization packages for armored vehicles, weapon stations you mount on vehicles, advanced mortar systems, too.
And what's the star player there right now?
Unquestionably, in the land segment, it's the PULS launcher. That stands for Precise Universal Launch System. It's basically a highly mobile advanced artillery rocket system. Why is it so attractive, particularly in Europe right now?
Well, first, it's a platform agnostic. You can stick it on various kinds of trucks. And critically, it can fire a wide range of ammo, NATO standard rockets, missiles from different suppliers. That flexibility, plus its long range, gives NATO countries the kind of supply chain resilience and reach that, frankly, a lot of their older Cold War systems just don't have.
Interesting. Okay, then there's a really unique, and you said critical, segment. Elbit Systems of America, or ESA. That's 21% of revenue, $1.586 billion. This isn't just a sales office, right?
No, not at all. ESA is a core strategic tool. It's designed to operate just like a local, fully compliant U.S. defense contractor.
A strategic firewall, you called it earlier. Exactly. The ESA acts as their primary firewall. It focuses on making key things like night vision systems, maritime sensors, advanced displays, right there inside the U.S. defense industrial base. By meeting strict U.S. rules on local content, hiring U.S. citizens for key engineering jobs, using local supply chains, ESA essentially insulates a big chunk of Elbit's revenue from political decisions made in Washington about U.S.-Israel relations. It creates some distance.
Clever. Okay, moving to the more specialized tech-heavy areas. We've got A-Star and EW. That's intelligence, surveillance, target acquisition, and reconnaissance, plus electronic warfare. 18% of revenue.
Yeah, think of this as the nervous system of modern warfighting. The EW part includes sophisticated countermeasure systems designed to protect aircraft, ground troops from modern radar threats, missile threats, and the ISTAR side. That's all about collecting, merging, and spreading huge amounts of battlefield data. Absolutely essential for gaining what they call information superiority.
Right. And finally, the smallest segment, C4I and cyber, at 11%, or about $800 million. But this sounds like the glue holding it all together.
It really is. This provides the central command backbone. C4I is command control, communications, computers, and intelligence. Think tactical radio networks, secure data links, the battlefield management software that connects everything from the other 4 segments.
Okay, so 5 segments. But you stress they don't operate in isolation.
Absolutely not. The crucial thing to grasp about Elbit's strategic edge is this system of systems value proposition. They're not just selling individual products like a sensor here or a radio there. They're selling integrated, multi-domain solutions that are specifically tailored for modern networked militaries.
I get the term system of systems, but let's break down the actual value. How does combining these 5 different areas create something better for the customer than if they just bought pieces separately?
Okay, good question. Look at that massive $1.635 billion contract they announced from an unnamed European country back in August 2025. That wasn't just them selling some missiles, it was a total solution. It bundled their POS artillery systems from the land segment with their Hermes UAS drones from aerospace. And then, crucially, it tied everything together using robust C4ISR solutions, drawing from the ISTAR and C4I segments.
Ah, so the customer isn't just getting rockets, they're getting the whole package. The intelligence gathering from the drone, the real-time data processing, the secure communication to send the firing command, and then launching the rocket. All in seconds, presumably.
Exactly. And the integration is seamless, already tested under high stress. If a competitor tried to offer this, it might involve 3 or 4 separate contracts. Then the military itself would face a painful, complex job trying to stitch it all together. Elbit offers something much closer to plug and play. This creates a really deep operational dependence for the customer, which means durable relationships and, frankly, extremely high barriers for any rival trying to push them out.
That integrated advantage makes a lot of sense. Okay, now let's shift to that single aha data point you mentioned. The one that really shows how dramatically the current geopolitical situation has reshaped their business mix, this rapid geographic reweighting of revenue.
Yeah, this data is, well, it's stunning actually, because it fundamentally changes the company's risk profile. Historically, Elbit worked hard to keep a balanced geographic spread for its clients. So in the full fiscal year 2023, Israel accounted for a strategic but manageable 20% of their total revenue.
Okay, 20% in FY 2023. But then things changed.
Dramatically. By the end of FY 2024, so after the initial phase of the recent conflict began, Israel's share of their revenue had already jumped to 29%. That's a big move in 1 year. But the really striking figure comes from their latest quarterly filing.
Go.
By the second quarter of 2025, Israel's share of Elbit's total revenue had surged to 34%, one-third of their business. That is a material, almost instantaneous increase in dependency on a single customer, the Israel Ministry of Defense, the IMOD.
And the company itself links this directly, right? In their statements, they talk about a material increase in the demand from the Israel Ministry of Defense right after the Swords of Iron War started in October 2023.
Yes, they're explicit about it. Now, on one hand, this creates a powerful near-term tailwind. It validates their backlog, keeps production lines humming, drives those really strong, accelerating growth rates we talked about. But the consequence for you, the listener, the financial takeaway, is a dramatic increase in concentration risk.
Right. It means over a third of their sales, their production capacity, is now dedicated to fulfilling orders for just one customer. What does that actually do to their ability to prioritize, say, their European or North American clients? Does it cause friction?
That's the critical operational fallout. Elbit is facing some tough choices. Do they prioritize the IMOD? That guarantees near-term cash flow and reinforces that valuable battle-proven label. Or do they prioritize their established European customers who represent those crucial long-term strategic growth markets? We've already seen evidence of this friction. Deliveries to the Philippines, for example, were delayed because Israel needed those systems domestically. That creates tension. And think about it. If the IMOD spending normalizes, or if its procurement priorities shift even slightly, that would create a massive, sudden revenue hole for Elbit. Their fee, at least in the short to medium term, is now intrinsically tied to continued high-intensity demand from the Israeli military.
Okay, let's zoom out now. Shift focus to the bigger picture, the global stage. Because Elbit seems perfectly placed to capitalize on this global defense supercycle.
Yeah, and that term supercycle, it really is justified by the numbers. Global military spending hit an absolutely astonishing record, $2.7 trillion in 2024. And that wasn't just inflation making the number bigger. It was a 9.4% real terms increase. That's the steepest jump we've seen since the Cold War ended. It signals a fundamental and likely sustained policy shift across the globe.
The drivers are pretty clear, unfortunately. You've got the ongoing Russia-Ukraine war. That's basically forced Europe to completely rethink its defense capabilities after decades of, well, letting things slide. European defense spending alone shot up 17% in 2024.
And you're seeing real policy changes because of that. Critically, 18 out of the 32 NATO members now meet or beat the alliance's target of spending 2% of their GDP on defense. Just a few years ago, that number was tiny. We're seeing staggering budget hikes as a result. Germany boosted defense spending by 28%, Poland by a massive 31%. And this isn't just a one-off bump. It's looking like a sustained multi-year effort to rebuild and modernize forces.
And it's not just Europe, right? We also have to look at the Indo-Pacific. The competition with China there is fueling a regional arms race. I mean, Japan, traditionally pacifist Japan, just logged its biggest annual defense spending increase since 1952.
So what this all means for a company like Elbit is that the spending wave looks durable. It's driven by major geopolitical shifts that are forcing nations not just to maintain their militaries, but to seriously modernize them. And that naturally favors high-tech innovators like Elbit.
And this is where Elbit's specific tech focus really seems to pay off. This current cycle isn't just about buying more tanks or planes. It favors digital upgrades, next-gen systems. Let's break down the specific demand drivers for Elbit's main technologies.
Okay, starting with unmanned systems. Drones. The effectiveness we've seen in recent conflicts has just created massive global demand. Everything from the small tactical recon drones up to the big strategic ones like Elbit's Hermes 900. The global military drone market is projected to grow significantly from about $15.8 billion in 2025 to potentially $22.8 billion by 2030. That's a huge tailwind for Elbit's biggest segment, aerospace.
Right. Second key area, C4ISR and networked warfare. This is all about information dominance, isn't it? The ability to collect data, process it, share it securely in real time, arguably more critical now than the physical platform itself.
Absolutely. And the market size reflects that priority. The global C4ISR market was already valued over $125 billion back in 2022. Projections put it near $160 billion by 2028. Elbit's ISTAR and C4I segments are right in the middle of this, providing the digital backbone that lets militaries fight as one connected force, not just isolated units.
Okay, and third, you mentioned advanced avionics, so upgrading existing aircraft.
Exactly. Putting in digital cockpits, better sensors, open architecture systems into older planes, it's much cheaper and faster than going through the whole decade-long process of buying brand new fighter jets. Elbit is a major player in this aircraft modernization space. So here's an interesting insight, maybe. Think about it this way. A giant Tier 1 contractor like Lockheed Martin or Boeing benefits when a country buys a new $100 million jet. Fair enough. But Elbit can benefit multiple times from that same scenario. They can sell the advanced sensors and displays inside the jet. They can sell the electronic warfare systems that protect it. They sell the network links that connect it to command centers. And they sell the unmanned systems, the drones, that support it from the air.
Huh. So Elbit is positioned to grab value all along that digital chain of command, or kill chain, which means they could potentially grow even faster than the overall defense market, which maybe gets weighed down by supporting older legacy stuff.
That's the potential, yes. Looking ahead, there are two massive tech trends already shaping Elbit's R&D. First is the huge push towards AI and autonomy. Think about all the data pouring in from those ISTAR sensors. You need AI just to process it effectively.
Right, and Elbit's active here. You mentioned things like frontier surveillance, their robotic autonomous suites, RAS.
Exactly. AI isn't just for analysis anymore. It's becoming essential for powering future autonomous weapon systems, managing complex swarms of drones or ground vehicles.
Okay, AI and autonomy. What's the second big trend?
The second is the Modular Open Systems Approach, or MESA. Defense departments, especially the US DoD, are really pushing hard for open architecture standards on all new equipment.
Sounds necessary for interoperability, but you also hinted it could be a threat.
It's definitely a double-edged sword. On one hand, the opportunity is huge. MOSA makes it easier for Elbit to plug its best-in-class components, maybe a specialized sensor or a really high-res display, into massive, multi-billion-dollar platforms built by the bigger prime contractors like Lockheed or BAE. That opens up their market access significantly.
Okay, that's the upside. What's the downside?
The threat is losing that vendor lock-in. If all the interfaces are standardized and open, it makes it much easier for a customer 5 or 10 years down the road to just swap out an Elbit sensor for one made by a competitor. It reduces the stickiness that Elbit built its whole integrated system strategy on. So management has to ensure their components aren't just plug-and-play compatible, but actually functionally better than anyone else's.
So it forces them to compete purely on tech superiority, not just on being the incumbent integrator.
Pretty much. They have to shift from relying on the complexity of their proprietary integration to relying purely on having the best tech, which, given their whole battle-proven development cycle, is probably a bet they feel confident making.
Okay, we've laid out the strong business structure, the huge market tailwinds. Now let's look at the financial results that these trends have produced, because the acceleration here is pretty remarkable. It's definitely caught the market's eye.
Yeah, the numbers really do back up the whole macro story. Elbit's shown consistent, accelerating double-digit revenue growth. It went from 8% in 2023, jumped to 14% for the full year 2024, and then bam, the first half of 2025, growth surged into the 21% to 22% range, getting that kind of acceleration in what's normally seen as a mature, kind of bureaucratic industry like defense. That's really rare.
And that top-line growth is translating downwards, too.
Yeah.
Non-GAAP diluted earnings per share that shot up 55% year over year in Q2 2025 hit $3.23. We're also seeing margins improve steadily, right? Operating margins climbed from 7.5% in 2023 up to 8.9% in Q2 25. That suggests they're managing costs well, getting leverage.
Right, that's operational leverage kicking in as revenues scale up. And this brings us to maybe the most visible indicator of their success right now. The backlog, the order backlog. That's guaranteed future revenue, essentially. And it's expanded incredibly fast. It hit a record $23.8 billion as of June 30, 2025. Just think about that number. That's a 34% increase just since the end of 2023. Massive growth in committed future work.
$23.8 billion. That gives them huge revenue visibility.
Yeah.
Insulates them somewhat from typical economic cycles. And we know a good chunk of that is near term, right? About 46% is scheduled for delivery through the end of 2026.
That's right. which supports management's guidance for mid-teens revenue growth this year, 2025, and then continued double-digit growth into 2026. It seems baked in based on the backlog.
Okay, strong growth, strong backlog. But you wanted to highlight something else as particularly critical financially.
Yes. For me, arguably the most critical detail for assessing their long-term financial health is the free cash flow inflection point. This is where the growth on paper turns into actual hard cash in the bank.
Okay, explain that. Why is free cash flow, FCF, so important right now, especially for a defense company growing this fast?
Well, when a company ramps up production extremely quickly, like Elbit is doing, it often requires huge upfront investments in working capital. Buying more inventory, paying suppliers faster, maybe expanding facilities, all happening long before the government customer actually pays the final invoice for the delivered product. This is why, back in 2023, even though revenues were decent, Elbit actually reported negative free cash flow. They burned through $73 million. They were spending cash faster than they were collecting it.
Which signals rapid expansion, sure, but maybe not immediate financial stability. It costs money to grow that fast.
Exactly. But then in 2024, they pulled off a really exceptional operational turnaround, focused on efficiency, negotiating better payment terms on contracts, collecting receivables faster. And the result, FCF swung dramatically from that negative $73 million to a positive $320 million for the full year 2024.
Wow, that's a huge swing. So that shows they're actually managing to convert that rapid growth in the massive backlog into real tangible cash. They're not just growing revenue on the books. They're actually bringing cash in the door.
Precisely. And that trend has continued strongly into 2025, which really validates their operational management. Operating cash flow hit $304 million just in the first half of 2025, compared to only $26 million in the same period the year before. This ability to convert sales into cash efficiently is what gives them the capital they need for ongoing R&D and any future strategic moves like acquisitions.
Speaking of capital, how's the balance sheet looking? You mentioned the cash flow improvement.
It's robust. Their net debt to EBITDA ratio is quite low, around 0.9x at the end of 2024. And S&P recognized this financial strength. They upgraded Elbit's credit rating to IAA Plus back in June 2025. So they have financial flexibility.
And how is management using that flexibility, that capital? What are the priorities?
Reinvestment is definitely number one. They consistently spend a high percentage of sales on R&D, usually around 7-8%. That's absolutely necessary to stay ahead technologically in areas like AI, electronic warfare, unmanned systems. They also significantly increased their capital expenditures, spending $215 million in 2024, specifically to boost production capacity. They have to be able to actually build and deliver everything in that huge $23.8 billion backlog.
Makes sense. And any return to shareholders?
Yes, and this is a signal of management's confidence. They've actually increased the dividend twice already in 2025, bumping it up from $0.50 per share quarterly to $0.75. That tells you management believes this strong cash generation is sustainable. They're betting on the durability of this defense cycle.
Okay. So we've painted this picture of incredible financial acceleration, really fueled by global necessity, geopolitical shifts. But now we absolutely have to confront the other side of that paradox we started with, the significant geopolitical exposure and those unique operational challenges that make this company, frankly, profoundly risky despite the growth.
Right. First, let's just frame their competitive position again. Elbit is big, yes, ranked 22nd globally in defense revenue. But they are absolutely dwarfed by the Tier 1 giants, the U.S. and European primes. Elbit's 2024 revenue was around $6.8 billion. Compare that to, say, RTX, formerly Raytheon Technologies. They reported $80.7 billion. Elbit simply cannot compete head-to-head on pure manufacturing scale or volume.
So they don't compete on size. They compete on being nimble, on technology, and on that global strategy you mentioned earlier. We need to unpack that a bit more.
Yeah, the global strategy, global reach, local presence is really their operational answer to geopolitical risk. It means setting up these local, fully compliant subsidiaries in their key overseas markets. We talked about ESA in the U.S., but they have similar setups in the UK, Germany, Australia, and other places. And these subsidiaries, they don't just sell Elbit products made in Israel. They perform local R&D, they do local manufacturing, they hire local engineers and technicians.
Wait, how does that actually work as a strategic firewall? What does it protect them from?
It helps mitigate risk in a couple of key ways. First, it helps them meet local industrial content requirements. Many governments mandate that a certain percentage of defense spending must benefit their own domestic industry. Having a local subsidiary helps Elbit check that box, making the host government less likely to cancel a contract because doing so would mean job losses for their own citizens. Second, it physically distances parts of their supply chain and manufacturing footprint from potential issues centered purely on Israel. If political pressure ramps up specifically against Israel, a country might think twice about canceling a contract with an Elbit subsidiary that has built, say, a critical component right there within its own borders, using its own workforce. It's a way to try and maintain market access, even when the political winds shift dramatically.
But those firewalls, they're clearly not foolproof. We have concrete examples of direct geopolitical fallout costing them serious business. This is the risk side of the paradox playing out in real dollars and cents.
Absolutely. This is where the high stakes become very real. We've seen significant contract cancellations, major delays around the world, directly linked to the company's Israeli identity and operations. Look at Brazil, for instance. A $210 million contract for howitzer artillery systems got delayed back in 2024. Why? Intense political opposition within Brazil, domestic pressure groups lobbying against the deal, even though the Brazilian military clearly wanted the capability.
And maybe the most visible, most costly example recently was in the UK. The Ministry of Defense canceling that massive, high-profile £2.1 billion Watchkeeper drone program in November 2024.
That is a staggering loss. $2.1 billion. You could buy entire fleets of other systems for that kind of money. And significantly, official sources explicitly mentioned the persistent, intense activist disruption at the Elbit manufacturing site in the UK as a major contributing factor in the MOD's decision to pull the plug. The relentless protests, the site blockades, it made the company and the program a political liability for a key Western government partner.
So the activist pressure essentially put a direct financial cost onto Elbit's books, one that management couldn't fully mitigate despite the local subsidiary strategy.
Exactly. We also saw reports of contract cancellations bubbling up in Spain and Italy, totaling around $140 million, again happening amidst broader European political debates and shifts regarding defense deals with Israeli firms. And as we touched on earlier, their need to prioritize domestic Israeli requirements led to those delayed deliveries to allies like the Philippines. That creates diplomatic friction and could definitely jeopardize future potential contracts in Asia.
This all feeds directly into the broader reputational risk issue, doesn't it? Elbit is just a constant, highly visible target for ethical investment campaigns, ESG-focused divestment pushes.
It really is. When the world's largest sovereign wealth fund, Norway's, decides to divest, and when massive global financial institutions like HSBC and AXA follow suit, citing ethical concerns, that puts constant downward pressure on the stock's valuation. It potentially makes it harder or more expensive for them to access capital markets in the future, too.
It's a kind of structural disadvantage that their big Tier 1 competitors, like the U.S. primes, just don't face to nearly the same degree.
That's a good way to put it. It means even if Elbit executes perfectly on the technology, on the operations, they constantly have to fight against this political drag when it comes to securing and keeping international contracts.
Okay, so that's the external political pressure. But the company also faces some really unique internal operational constraints that could threaten their ability to actually deliver on that massive $23.8 billion backlog.
Yes. That sudden surge in demand, especially from the IMOD, has put a severe strain on their global operations. I mean, beyond the general supply chain headaches everyone's facing, like higher transport costs, those Red Sea shipping delays from Houthi attacks, persistent shortages of key electronic components for their avionics and C4ISR gear.
There's something more specific to Elbit, related back to that core IDF relationship.
Exactly. It's the labor mobilization risk.
Explain that.
This is a risk that's almost unique to companies heavily based in Israel. At the peak, after the conflict flared up in October 2023, roughly 15% of Elbit's Israeli workforce was called up for military reserve duty. And we're not talking about, temporary admin staff. We're talking about highly skilled engineers, specialized technicians, key R&D personnel, the people designing and building their most advanced systems.
Okay, wait. If 15% of your most critical, specialized employees are suddenly unavailable because they've been deployed, does that mean the $23.8 billion backlog is effectively smaller?
Yeah.
Because they literally might not have enough skilled people to staff the production lines or the R&D projects needed to deliver it on time.
That is precisely the consequence. The unpredictable removal of such a significant chunk of their skilled labor force directly disrupts production schedules. It delays critical R&D programs needed for future growth, and it directly constrains the company's internal ability to scale up production to meet both the IMOD's urgent demands and that mounting international backlog. It's an internal operational bottleneck directly caused by the external geopolitical situation. The ultimate double whammy, really.
Wow. Okay, that perfectly sets up our final sections.
Yeah.
Let's talk about management's strategy to try and navigate this incredibly complex environment, and then finally, what the market is actually willing to pay for this very high-risk, high-reward profile.
Right. Management seems focused on finding structural, long-term growth opportunities that might help reduce their reliance on single customers or volatile geographies. One key area they're pushing is the ongoing development of their robotic and autonomous systems architecture, or RAS.
So moving beyond just building the individual drones and ground robots themselves.
Exactly. They're aiming to develop the underlying operating system for future autonomous warfare. Think of it as platform-agnostic control software designed to manage complex networked swarms of unmanned platforms, air, land, sea, all working together simultaneously. Elbit wants to position itself to provide the high-margin brains that run these autonomous systems, which is a business model that could be highly scalable and maybe less dependent on which specific hardware platforms win contracts.
Interesting. What's another strategic pillar? You mentioned Europe earlier.
Yes, the continued focus on European modernization. Outside of Israel itself, Europe has been the most successful high-growth market recently. Elbit's sales in Europe grew an incredible 106% just between 2021 and 2024. That growth was fueled mainly by demand for things like their PLS artillery systems and their electronic warfare suites. Given the sustained commitment we're seeing from NATO nations to hit that 2% defense spending target, Europe looks locked in as a crucial growth engine for Elbit for at least the next decade, assuming they can manage the political risks.
Okay. And finally, any signs of major moves on the acquisition front? Strategic M&A. They raised a lot of money recently.
They did. Back in May 2025, Elbit executed a pretty large public offering, raising nearly $589 million in fresh capital. And they've been noticeably quiet on the large-scale acquisition front for a little while now. That suggests they might be conserving those resources, plus their strengthened balance sheet, for a potentially significant deal down the road. This could be aimed at, say, accelerating their entry into a new high-growth area, maybe space-based intelligence gathering or specialized cyber defense capabilities, using their capital to try and leapfrog competitors in a key future domain.
Okay, makes sense. Now, turning quickly to the people in charge. Management and governance.
Yeah.
The CEO, Bizel Maklas, he's got deep roots in this sector, right? Been with Elbit since '91, former IDF artillery officer himself.
Yeah, the leadership team definitely understands the customer, the technology, the operational pressures intimately. That's a strength. However, the governance structure is worth noting. There's significant concentrated ownership. A holding company called Fetterman Enterprises Ltd. controls 42.3% of Elbit's shares. Now, while the board itself includes some very high-level former governmental and military figures, people like former Foreign Minister Tzipi Livni, which certainly helps reinforce those crucial government connections, this concentrated ownership by Fetterman does limit the practical influence of public minority shareholders. That's just a factor investors need to be aware of when thinking about corporate oversight.
Got it. Okay, now for the final crucial piece of this puzzle, the valuation. Because despite all the very real, very material risks we've spent time detailing, the market seems to be treating Elbit Systems like some kind of runaway, high-growth tech stock, not like a typical, more conservatively valued defense contractor.
Right. Let's really unpack this valuation premium. The stock is trading at a level that's significantly above both its own history and its global peer group. The trailing 12-month price-to-earnings, or PE ratio, it's currently fluctuating in the range of 49 to 57 times earnings. Just think about that. That is dramatically higher than Elbit's own 10-year historical average PE, which is around 29x. And it's nearly 3 times the valuation multiple of big established Tier 1 peers like Northrop Grumman, which trades closer to 21.9x earnings.
Okay, so why? Why is the market willing to pay 50, almost 60 times earnings for a company making artillery systems and drones, however advanced they are, especially given all the risks?
Well, that premium seems entirely built on the expectation of sustaining that incredible growth rate. We saw that 20% plus revenue surge in the first half of 2025. The market is betting they can keep that pace up. It's also betting on them successfully executing that entire $23.8 billion backlog, converting it all to revenue efficiently, and simultaneously expanding their operating margins up towards management's long-term target of around 10%. Essentially, investors are pricing in multiple years of very high, sustained, and maybe implicitly risk-free growth.
Which immediately sets up substantial valuation risk. What happens if that growth rate starts to slow down? Maybe because of those geopolitical headwinds we discussed, or the labor mobilization issues constraining production? What if growth decelerates back towards, say, a still healthy but more normal mid-teens percentage for the defense industry.
The consequence for the stock price could be severe. The valuation multiple itself would likely compress sharply. If you have a stock trading at 57 times earnings and the market suddenly decides it only deserves to trade at, say, 30 times earnings, which would still be a premium to peers, the stock price could theoretically fall by nearly 50% or even more. And that could happen even if the underlying business remains perfectly profitable and continues to grow at a decent clip. The risk here is purely one of extremely high expectations colliding with the messy reality of operational constraints and geopolitical friction.
And when we look at it through the lens you emphasized earlier, free cash flow, does the valuation still look stretched compared to the actual cash being generated today?
Absolutely. If you calculate the historical free cash flow yield, based on that successful $320 million FCF number from 2024, it comes out to a very, very low 1.4%. That strongly suggests the current share price isn't really justified by the cash the company is generating right now. Investors are placing a massive bet on huge FCF growth years into the future. They're putting enormous faith in management's ability to execute flawlessly on this very high-stakes, high-risk backlog.
Okay. This deep dive has really taken us through the complexities of Elbit Systems. We've seen a company that is undeniably strongly positioned right at the crossroads of a global defense supercycle and the demand for next-generation warfare tech drones, C4ISR, AI, network systems. And this structural advantage has clearly fueled record financials, that accelerating growth, and the massive $23.8 billion backlog.
And yet, we've kept coming back to that central defining conflict. The very source of their technological edge, that battle-proven status earned through active conflict involvement, is, at the same time, the direct source of their significant commercial, political, and reputational risk. It's an enterprise offering potentially very high rewards, but it comes packaged with uniquely high volatility and uncertainty.
We've broken down the business structure, the integrated advantage, that incredible financial acceleration, but also the real-world impacts of the geopolitical risks from losing huge contracts like the UK's Watchkeeper drone program due to protests to major institutions divesting their shares.
Which brings us neatly to our final thought for you, the listener, to ponder. We established early on that the defense industry, broadly speaking, tends to be somewhat insulated from typical economic recessions. People still buy weapons when the economy is down. But Elbit, as we've meticulously detailed throughout this deep dive, seems uniquely exposed to the sharp, unpredictable volatility of political cycles.
So, given that the company's ability to actually turn that record $23.8 billion backlog into delivered products and revenue is constrained by both external factors, like activist protests that can directly lead to multi-billion-dollar program cancellations, and it's constrained by internal operational factors, like having up to 15% of its crucial, specialized Israeli workforce suddenly mobilize for military reserve duty, disrupting production and R&D.
Here's the final question. Which of these intertwined risks is ultimately harder for Elbit's management team to control? Is it the external geopolitical crisis and the resulting political pressure applied by foreign governments and activist groups? Or is it the internal operational chaos that crisis creates, the labor shortages, the production disruptions? Put another way, can management firewall its internal processes and its key people more effectively than it can firewall its international contracts from the storms of geopolitics? Getting your own handle on that question is probably essential as you evaluate the very high-stakes future of Elbit Systems.